Bosh, how's it going everybody? My name's TradeX, this is my trading den, and today we're going to be talking about primary and secondary entries. If you find yourself in the position getting into trades only to get stopped out before seeing price move in your ultimate direction, then this video is probably going to be for you. We're going to talk about the importance and difference between a primary and secondary entries so that you can understand where to place your stops more effectively so that you can start taking more effective trades. So guys, without further ado, let's get this intro rolling and then we'll jump straight into the good stuff. See you on the other side. Bosh, how's it going everybody? Here you'll find me top right of your screen. What we're going to do is break down what a primary entry is and what a secondary entry is and why this is important for trade management, okay? Primary entries, in a nutshell, are hyper-aggressive entries that come with no confirmation. These come in the form of long-term highs, intermediate-term highs, and they also come in the form of turtle suits. Now, a long-term high would form when a higher time frame PD array has been met, and you're not expecting price to break through that level. It is a level where we are anticipating price to retrace or reverse from. A long-term high is a high which forms that has two short-term highs either side of it, and it has fulfilled a higher time frame objective. The second type of primary entry is an intermediate term high. An intermediate term high is a high that forms with two short-term highs either side that has filled all of the inefficiencies and imbalances in price below the long-term high. Your second option for a primary entry. Third option for a primary entry is a turtle soup. A turtle soup is when we are anticipating buy side. In this example, because we're looking for bearish continuation, we'd be looking for buy side to be purged before continuation trade. For an example, in the PM session, we're looking for a run on lunch liquidity for continuation to the downside during the PM session. That would be a turtle soup setup. Again, an aggressive entry because there is no confirmation. We're entering above the buy side without any market structure shift or displacement. It's a hyper aggressive entry. So why is this important to know? Because this provides us the context as to where we place our stops. So I get in aggressively, and I often look for aggressive long-term high entries because it allows me to keep my stops very, very tight. If price breaks through this buck stop level, which I call them, so the level I'm not anticipating price to break through, then my trade thesis is probably wrong. So my stops are very, very tight. My second option is an intermediate term high. Again, when this forms, my stop goes above the intermediate term high. Why? Because all of the inefficiencies and imbalances have been filled and the long-term high has filled the higher time frame PD array objective. So my intermediate term high becomes where I place my stop. Now, that's primary entries. What's important to know is secondary entries, because what a lot of new traders do is they enter on secondary entries, and there's nothing wrong with that. So a secondary entry in a nutshell is an entry which comes with confirmation. Confirmation in the form of a market structure shift and displacement. What do I mean by that? A market structure shift and then return into a mitigation block, breaker block, fair value gap, OTE, order block. All of this is return to. It's a confirmationary trade. But what we need to be aware of on a secondary entry is that price can go through that level and wick into PD arrays just above it. Because it is a secondary entry, price has the ability to move through that PD array and pressure your position. We often say wicks do the damage, body tell the story. So we have to allow price to go through this mitigation block into a fair value gap, into an order block if necessary, but we do not want it to go above the intermediate term high if there is one. If we are getting in on a secondary entry, we have to apply the 3 PD arrays broken and we are FCUK'd rule, right? What do I mean by that? If we get on a MIT, let's say above it we have a fair value gap, order block, rejection block, we have to allow it to go into those by wicking before our trade thesis is invalid. Okay, so what will happen often is price will wick through but then close back inside that mitigation block. It's in that wick that a lot of new traders get taken out only to then see price move in their direction. Market makers will often pressure secondary entries because this is where the majority of people are getting into their position, and it is wanting to take those out of the trade before price moves in the ultimate direction. It's called offset accumulation. What we need to be mindful of is this. Primary entries are the most aggressive entry we can get on, but they allow us to define very, very clearly where we place our stops because we are not anticipating price to break through those levels. Secondary entry, we have to allow price to break through 3 PDRAs via a wick before our trade thesis becomes invalid. If there is no intermediate term high form, then we use the 3 PDRA analogy. If an intermediate term high forms, then our stop goes above the intermediate term high. This is where risk management comes into effect. Because what a lot of new traders will do is they'll be trading the minis and they don't want to open themselves up to a 5-handle risk. So they end up choking their trade unnecessarily because they want to keep their risk tight. But what happens is price breaks through their level, wicks into their stop before continuating down. How often does that happen? So guys, let's jump into some live charts and this will start making some more sense. Okay guys, here's an example from Friday the 11th. We're going to go through a couple of examples just to put this into practice. But what we had here on Friday the 11th was a primary and a secondary entry. And we're going to talk about how we could have used the information we've gone through today to better manage our stops on the second entry. Okay. Now what we had here at 11:30 was a classic London close reversal. A London close reversal where we're looking to go and run the AM session liquidity. During the AM open, the CME open, we had this mitigation block form. This is where we would be looking for a long-term low to form. How did it form in this scenario? Well, we had this mitigation block. Inside of that, it's clearer on the 5-minute. On the 5-minute, we had this BISI form, which was supported by this order block, which validates this is a very strong, high probability order block. This candle on the 5-minute filled this BISI entirely. It's at this point I'm looking for a long-term low to form, okay? Because we have fulfilled the objective on the higher time frame. If we jump down onto the lower time frame, I'm looking for a long-term low to form. And what do we have? We have a low with 2 short-term higher lows either side, right? This validates this is a long-term low. Therefore, my stop has to go below this low until an intermediate term low forms, all right? Now, if I got in aggressively on a fill of this 5-minute BISI into that 5-minute order block, I'll be holding my stop below this low. Now, if I didn't get in that entry, the second opportunity would be a secondary entry. And the classic would be a return to OTE. Now, there's nothing wrong with this. This is absolutely fine. But what will happen often with a new trader is they don't know where to place their stop in this range. And this is the difference in knowing what a primary and a secondary entry is. This is a secondary entry. And because there is no intermediate term low here, our stop has to go below the long-term low. Why? Because there are still inefficiencies that price can dip into. There's still this order block that price can run into because there is no intermediate term low. If an intermediate term low is formed, and if we remember, that is where all inefficiencies and imbalances have been filled in the displacement leg above the long-term low, that would provide our stop placement. That's where our stop would go at that intermediate term low. But as we do not have that in this trade entry, our stop would have to go below this long-term low. Now, what will normally happen is you'll get in here, you'll place your stop above looking to run the AM session liquidity. You've got the trade absolutely nailed down to a T, but you don't know where to place your stop. This is a classic example. Let's say we said, oh, this trader didn't want price to go through medium threshold of this order block. Well, guess what? This would have been a classic example where price ran their stop before ultimately moving in the direction which they had planned out. This is offset accumulation. Where would our stop have to go in this instance? Below the long-term low. And why? Because we have 3 PDRAs between our entry and the long-term low. We have this fair value gap. We have this order block. Then we have the old low. If 3 break, your trade thesis is probably wrong, okay? Or if an intermediate term low has formed, okay, that is where your stop goes. So what can we be looking for once we get in this trade? So at the moment, we got in here, our stop goes below this low. At what point can we move our stop up? When an intermediate term low forms. An intermediate term low is formed when we have a low which has filled all the inefficiencies and imbalances in price, and we have 2 short-term lows either side. Well, this is a short-term low, intermediate term low, short-term low. It's at this point our stop can go below this low here. So if we're still in our trade, the stop goes below this low and we then hold trade to target. If price breaks below this intermediate term low, our trade is probably invalid, move to the sidelines. But this is the difference between getting stopped out and holding a trade to terminus. Very, very close to stopping you out, of course, but ultimately it didn't. And this is effective trade management. Now, let's have a look at another example from Thursday the 10th, and this is actually what we traded in for CPI inside of Red Pill, and we actually took this trade, but what we were looking for was a purge of this buy side, a run into this SIBI, and a run into this higher time frame order block as an entry to go short. Okay, we also had an inverted fair value gap over here, and we were also looking for this 5-minute SIBI to fill. This forms the long-term high because we're not anticipating price to break above this high. What are we then looking for? Either an intermediate term high to form or a secondary entry where we can get in with our stop going above either the intermediate term high or the long-term high. Okay, so if we got in aggressively, our stop goes above this high, price aggressively displaces lower. This would be a classic example where a trader may get chopped up because they see this displacement leg and they're looking for a return to OTE. And they're looking at this fair value gap after a break of market structure. This would be their entry. Now, you can go in here and, a trader may put their stop just above mean threshold of this order block because they understand that if price goes above an order block's mean threshold, then it's, this order block is probably, less favorable and it's likely to run through that. This is a case where your stop would still have to go above this high. Why? Because we have no intermediate term high form yet. Without there being an intermediate term high form, we have to allow 3 PD arrays to break. The first is this fair value gap, then mean threshold, then this high into this rejection block. So my stop would still be above this old high until an intermediate term high form. What is an intermediate term high? It's a high with all the inefficiencies and imbalances in price have been fulfilled, and we have 2 short-term highs either side. So where's our intermediate term high here? It forms right here. So when this candle forms, and we have a short-term high and a short-term high form, okay? So when this candle forms, this is when my stop goes above this intermediate term high. Price should now no longer go above this high. So if you're getting in on this fair value gap entry, your stop still has to go above this high until this intermediate term high forms, okay? Because this is the occasion where price may run and take these highs, but not take the long-term high, creating an intermediate term high up here before aggressively displacing lower. So there you have it, guys. I hope you found that useful. I hope that gives you some indication of where you should be placing your stops during secondary entries. If you found value in this video, please do consider smashing the like and subscribe as always. And until next time, trade safe, trade smart, and I will catch you on the next episode. Take care.